Want to build lasting wealth? It's not about chasing trends or picking random stocks. It's about creating a stable, diversified portfolio that grows steadily over time. Whether you're just starting or refining your strategy, these 5 key investments will set the foundation for long-term financial freedom. Number 5. Dividend-focused ETFs. When it comes to building a reliable investment foundation, dividend-focused exchange-traded funds are an excellent choice. These ETFs invest in companies that pay regular dividends, creating a steady stream of passive income. This type of investment offers 2 distinct advantages: stability and cash flow. Dividends are typically paid out quarterly, providing a reliable income stream that can be reinvested or used for daily expenses. Companies that pay dividends tend to be more established and financially stable, often outperforming more volatile investments during economic downturns. The consistency of dividend payments helps mitigate the risks posed by market fluctuations. In fact, these companies often hold their value better than others when negative economic data or news causes stock prices to dip. Take, for example, the SHD ETF, which invests in dividend-paying companies like Coca-Cola, Pfizer, and Verizon. Since its launch in 2011, SHD has grown by over 270%, with a current dividend yield of around 3.4%. For every $50,000 invested, this would provide an annual dividend payout of about $1,700. While dividend-focused ETFs may not offer the explosive growth potential of other investments, they are incredibly important for long-term financial stability, particularly as you approach retirement. As a younger investor, dividend ETFs can be a smaller part of your overall portfolio. However, as you age and move closer to retirement, shifting more of your investments into these ETFs can provide a reliable income stream to supplement other savings. Number 4. Cryptocurrency. Cryptocurrency has become an essential part of many modern investment portfolios. While it's a highly volatile asset class, the potential for significant gains has attracted investors seeking high-reward opportunities. If you're just starting out and considering cryptocurrency, it's essential to understand the risks involved. Crypto investments should make up only a small portion of your portfolio, no more than 5–6%, especially if you're new to this space. The author of the original content has been investing in crypto since 2011 and has seen substantial returns. However, cryptocurrencies like Bitcoin have experienced major price swings, making them a high-risk, high-reward option. For instance, Bitcoin was launched in 2009 but didn't surpass $1,000 per coin until 2017. It reached highs of nearly $20,000 in late 2017, only to crash and then surge again to over $100,000. Despite the volatility, crypto remains an attractive asset class for many. For beginners, it's important to only invest money you're willing to lose. Additionally, it's wise to use platforms that are federally regulated, such as SoFi, which offers a safer way to buy, sell, and hold cryptocurrencies. If you're comfortable with the risk, a small investment in crypto can be a worthwhile component of a diversified portfolio. Number 3. S&P 500 ETFs. When it comes to stability combined with growth, the S&P 500 is often considered the gold standard. This index tracks the 500 largest publicly traded companies in the United States, including tech giants like Apple, Amazon, Microsoft, and healthcare leaders such as Johnson & Johnson. By investing in an ETF that tracks the S&P 500, such as SPY or V, you are not only gaining exposure to these market leaders, but also enjoying broad diversification within your portfolio. Over the long term, the S&P 500 has historically delivered an average annual return of 9.8% before adjusting for inflation. While it's important to note that this return isn't guaranteed every year, since market conditions can vary, the S&P 500's consistent performance over decades has made it one of the most reliable investment options available. The companies included in the S&P 500 tend to be stable, with strong earnings growth, which makes them ideal for investors seeking a balanced portfolio with both stability and growth potential. One of the biggest advantages of investing in an S&P 500 ETF is diversification. By purchasing just one ETF, you're effectively spreading your investment across 500 of the largest and most financially stable companies in the US. This diversification helps reduce the risk associated with individual stocks. If one company struggles, the overall impact on your portfolio is likely to be minimal. Moreover, many of these companies have global operations, offering exposure to international markets as well. For those looking to minimize risk while still achieving substantial long-term growth, the S&P 500 remains an excellent foundational investment. Number 2. NASDAQ 100 ETFs. For those who are willing to take on more risk in exchange for higher growth potential, the NASDAQ 100 is a compelling investment option. Unlike the S&P 500, which includes a mix of industries, the NASDAQ 100 focuses primarily on the largest non-financial companies listed on the NASDAQ stock exchange. The majority of these companies are in the technology sector, making this ETF particularly appealing for tech enthusiasts who believe in the continued growth of this industry. Some of the key companies included in the NASDAQ 100 are Microsoft, Nvidia, Alphabet, and Tesla, which are all major players in the tech world. Historically, tech stocks have outperformed most other sectors, especially over the last few decades, due to the rapid pace of innovation and demand for technological products and services. For younger investors who have a higher risk tolerance and are seeking significant growth, a NASDAQ 100 ETF like QQQ can offer substantial returns. The ETF is highly concentrated in technology, which means it benefits more directly from tech growth than a broader index like the S&P 500. However, it's essential to understand that this higher potential for growth comes with a greater degree of risk. Tech stocks, especially those in emerging fields like AI or biotech, can experience extreme price fluctuations. For instance, during market corrections or economic downturns, tech stocks often suffer more significant declines than more established, diversified companies. Therefore, if you're closer to retirement or prefer lower risk, this may not be the best fit. But for younger investors with a long-term outlook, tech-focused ETFs can provide explosive growth potential, making them an excellent choice for building wealth over time. Number 1. Investing in yourself. While financial assets are essential for building wealth, investing in yourself is just as crucial, if not more so. Whether it's gaining new skills or improving financial literacy, investing in your education can increase your earning potential and help you make smarter financial decisions. The journey from a $0 portfolio to $100K doesn't happen solely through investments. It often relies on increasing income and savings. For example, saving $12,000 a year for 7 years at a 5% return will get you to $100,000. But 84% of that will come from your savings, not your investments. Conversely, if you save $7,000 a year but achieve an 11% return, it will take 9 years to reach $100,000, with 63% coming from your savings. Increasing your income through upskilling is one of the most effective ways to build wealth. Whether it's improving your current job skills or learning new ones that can lead to promotions or new career opportunities, investing in yourself yields the highest returns. Financial literacy is another critical area. Understanding how to manage money, reduce debt, and optimize investments will lead to better financial outcomes over time. Ready to take control of your financial future? Start investing smartly and build wealth with these proven strategies. If you found this helpful, like and subscribe for more tips on achieving financial freedom. Let's grow together.